deadly mistakes, and false ideas. There is nothing more difficult than teaching someone something they believe they already know. Why is it that intelligent, well-educated people, successful in their professional fields, sometimes even those who have earned millions of dollars, so often fail catastrophically when it comes to investing? This question is not a paradox. It is a diagnosis of human nature, of the structure of modern financial systems, and above all, of how we perceive risk in a noisy and chaotic world. Over 3 decades of observing markets and the behavior of those who place their fate into cold numbers, I have never seen a mathematical formula that could accurately explain why people so often act against their own interests. Not because they do not know, but because they believe they know too much. This book does not promise to turn you into a financial genius, but if you are patient enough and brave enough to look at yourself honestly, it may help you avoid the common mistakes that most people fail to see, or worse, see clearly and still walk into as if nothing will happen. The real question is not how to invest, but why we continue to believe in the very ideas that have already caused us to fail. Before we begin, I encourage listeners to seek out the full book if they wish to experience the ideas in their entirety. For now, let us begin with a summary. False ideas. After more than 20 years watching markets and observing how people gamble their futures on cold, emotionless numbers, I realized something that seems obvious, yet is most often forgotten. Most investment failures do not come from a lack of intelligence, but from false beliefs. It is not that you are not capable, it is that you are listening to the wrong people. You trust ideas that should not be trusted. You act as if the market were a mythical story where every storyteller speaks the truth. It usually begins in a place that feels harmless, a morning coffee table, a television turned on to a financial channel, a well-dressed expert speaking confidently about how the market will rise 20% next quarter. You listen, you nod, you take notes, and then you act. In that moment, you have just wagered your future on a voice recorded under studio lights. What you do not know is that most advice like this, whether from famous analysts, television commentators, or confident voices on social media, is largely noise. Not because these people are malicious, but because they themselves do not know that they do not know. The strange thing is this: the more famous the advice, the more dangerous it becomes. Fame creates the illusion that someone is immune to being wrong. Names that once inspired millions to believe they were listening to brilliance were later ignored completely by reality. The market does not care about confidence. The market is a machine that crushes ego with uncompromising truth. And that truth shows that most forecasts are not only wrong, but financially destructive. I once met a man at an investment seminar. He owned a small auto repair shop, never went to university, but read financial news diligently. He told me he had invested his entire retirement savings into a technology stock recommended urgently on television. 3 months later, the stock collapsed. "I thought I had found a shortcut," he said, his voice still carrying bitterness. The The cost of bad advice is not only money, it is time, it is trust, it is self-respect. We live in an age where information is both the cheapest commodity and the most dangerous. You can scroll through dozens of financial headlines and podcasts every day, all trying to convince you that something is about to happen. The market will crash. This is the opportunity of a lifetime. Digital assets will replace all traditional money. The truth is simple. No one knows what will happen, and the only person who bears the consequences is you, not the one speaking. Here is a paradox I firmly believe in. The less you listen, the better your chances of doing the right thing. The best investment advice I ever received came from someone who never spoke publicly. No social media, no conferences, no interviews. He said only this: know exactly why you are buying something and prepare the reason you will exit. No drama, no grand language, yet closer to truth than any breaking news headline. The problem is not only individuals. Financial media itself is an ecosystem built on stimulation. It is not designed to make you wealthy. It is designed to keep you engaged. Look at the headlines. Markets collapse. Get out now. Don't miss this once-in-a-century opportunity. That is not information. That is dopamine wrapped in bold fonts. Investment is not entertainment. It is slow, boring, disciplined. It has no background music, no applause. And because of that, you rarely see it on television. Yet that boredom is the foundation of lasting wealth. Truth is less attractive than drama. That is why you rarely hear it. Distorted numbers. If bad ideas are the fire that burns wealth, then distorted numbers are the invisible wind that turns that fire into disaster. The author does not stop at exposing meaningless advice. He goes deeper into numbers themselves, things that appear objective, scientific, and precise, yet can completely mislead investors when taken out of context or misunderstood. We begin with mathematical blindness. Many investors read headlines like, "The index fell 300 points," and immediately panic. But what does 300 mean? Without a denominator, a number is meaningless. If an index stands at 40,000 points, a drop of 300 is less than 1%. But if it stands at 3,000, the same number is an earthquake. The problem is not whether a number is big or small. The problem is losing the ability to measure proportion and impact. This is what I call denominator blindness. Next comes survivorship bias. You constantly see winning investment funds featured in the media, successful startups flooding the internet, but you never see the bodies, the funds that quietly shut down, the companies that failed and vanished from history. Looking only at survivors, you begin to believe that everyone who invests gets rich, that every startup succeeds, and so you step into the trap with false expectations. The author also warns about asymmetry in investing. A 50% loss cannot be repaired by a 50% gain. Lose half of your capital, from 100 down to 50, and you now need a 100% return just to break even. Mathematics does not forgive large mistakes. Compound interest, too, is a double-edged sword. It is your greatest ally if you are patient and disciplined. but it becomes your enemy when fees, taxes, and transaction costs compound against you over time. A 2% annual fee is not just 2%. Over decades, it silently consumes a massive portion of your potential wealth. Then there is framing. The same data, presented differently, leads to entirely different decisions. A fund returning 15% last year sounds impressive, but stretch the time frame to 5 years and discover that the average annual return is only 2%. Suddenly, the story changes. A manipulator does not need to lie. They only need to frame the truth. From these observations, the author reaches a clear conclusion. Numbers never speak for themselves. They are tools. And like any tool, they can build or they can destroy. A skilled craftsman understands how to use a hammer, a chisel, and a ruler. A thoughtful investor must understand what truly lies behind every number on a financial screen. The goal is not to turn you into a mathematician, but to make you intelligent enough not to be fooled by those who weaponize numbers in a world where information itself has become a form of power. Survival does not belong to the smartest person in the room, but to the least naive. I once witnessed a market sell-off triggered by employment data. Unemployment rose from 3.7% to 3.8%. Within minutes, billions of dollars evaporated. What most people did not realize was that this change fell within the statistical margin of error. In reality, it meant almost nothing. But media does not have time for context. Headlines only say, "Unemployment rises," and panic follows. Markets do not react to reality. They react to how reality is narrated through numbers. Consider the price-to-earnings ratio, one of the most worshipped metrics in investing. Low PE means cheap. High PE means expensive. Simple. Until you realize that PE does not tell you how a company will perform. It only tells you what the market expects. Sometimes a high PE reflects real growth potential. Other times it reflects collective speculation. Same number, completely different meaning. Valuation models sound scientific. You input growth assumptions, discount rates, future cash flows. Out comes a fair value, but change your growth assumption from 6% to 5%, and the valuation may shift by tens of percent. At that point, the model is no longer objective. It becomes a mirror reflecting your own bias. I have seen funds that only recommend buying stocks meeting strict quantitative criteria. Low PE, minimum revenue growth, clean balance sheets. The spreadsheets look impressive, yet they still invested in companies committing accounting fraud, because numbers are created by people, and people know how to polish them. This is why I am cautious of rankings like Top 10 Stocks of the Year, or 500% gain in 6 months. These lists say nothing about repeatability. They only tell stories about the past. And investing by looking backward is like driving a car while staring only into the rear-view mirror. The mirror is small. The dangerous turns lie ahead. There is a cruel irony in investing. The more data you consume, the more likely you are to become confused. This is called analysis paralysis, Surrounded by hundreds of indicators, you believe more data equals more control. In reality, it often distracts you from what truly matters: the business model, the people running the company, and its ability to generate sustainable profit. I once met a young investor who proudly showed me a spreadsheet with over 200 metrics for each stock in his portfolio. I asked him a simple question: "Do you know what actually makes this company's stock go up?" He was silent. There is a vast difference between having data and understanding it. Numbers cannot speak, yet we constantly force narratives onto them. And those narratives are often wrong. Successful investing does not require advanced mathematics. It requires enough clarity to doubt numbers that look too perfect, and enough humility to accept that not everything can be measured in a spreadsheet. Markets do not run on pure logic. They run on emotion, expectation, and psychology. And those forces do not fit neatly inside Excel cells. Sometimes a pause, a glance, or an unusual silence in a shareholder meeting reveals more truth than any quantitative indicator. Numbers, when not illuminated by deep understanding, do not become light. They become darkness disguised as logic. Do not worship them. Learn to listen to what is not said between the rows of data. And above all, remember this: survival in investing does not come from knowing more, but from not being deceived by what you believe you already know. Faulty behavior. Many people believe that crowds only make mistakes during market crashes. But after watching markets long enough, I have learned something different. Most investment failures do not happen in dramatic collapses. They happen quietly, through small behavioral errors that accumulate over time, like fine dust slowly covering a glass surface. Eventually, you can no longer see clearly. And here is the great paradox: wealthy people are not immune. I once studied a family that controlled billions of dollars. They were not gamblers. They were not reckless beginners. They were the Becker family, a symbol of immigrant success in America. Their story began with a fur trader who escaped Europe just before the Nazis invaded Poland. He arrived in the United States with nothing but hope and a few coins. Within a few decades, the family built enormous wealth. And then, almost all of it disappeared. Not because of war, but because of three classic mistakes that any investor can make: lack of diversification, misplaced trust, and the illusion of immunity to risk. They concentrated their wealth, placing deep trust in a single company, Enron. At the time, it looked untouchable. They believed they had reached a level where rules no longer applied to them. When Enron collapsed, they lost more than money. They lost an illusion, the belief that wealth equals intelligence, that success means protection from failure. This is where behavior begins. Behavior cannot be measured on a balance sheet, yet it determines survival. We are not biologically designed to invest. The human brain, shaped by millions of years on African savannas, was built to run from lions, to store food when resources appear, to distrust uncertainty. It was not built to handle stock charts, leverage, or compound interest. Markets are not jungles. And because of this mismatch, we sabotage ourselves. Bad behavior creates bad outcomes. Most investment mistakes fall into 10 major categories. No plan. Not understanding personal needs. Obsession with active management. Poor asset allocation. Over-concentration. Excessive fees. Failure to identify and control risk. Misplaced trust. Ignoring taxes. And finally, arrogance and lack of humility. I have sat across the table from investors worth hundreds of millions of dollars and realized they understood risk no better than a first-year student. They spoke proudly about legendary market calls, perfect timing, brilliant predictions, yet they could not explain why 80% of their portfolio sat in technology stocks based on nothing more than a feeling. A plan is the foundation, but most people enter markets with dreams, not plans. Dreams of quick wealth, dreams of financial freedom, dreams of proving themselves right. Unanchored dreams are swept away by waves, leaving behind broken portfolios and eroded confidence. Another rarely admitted mistake is misunderstanding one's own needs. Many investors act as if they will live forever. They delay withdrawals, hold through unbearable losses, wait endlessly for the perfect rebound. They forget one thing. Money is not only for growth, it is also for living. If you invest and forget how to live, you may die with a large account and no meaning. Active management is another temptation. It gives you the feeling of control, the illusion that you are doing something. That feeling has convinced millions to sacrifice stable returns in pursuit of beating the market. But the market does not need to be beaten. It only asks that you do not defeat yourself. Asset allocation. 3 simple words, yet one of the most common traps. Many believe that owning several good stocks automatically eliminates risk. They construct portfolios like puzzles, a bit of clean energy, some technology, a little real estate, a few growth stocks, and they think they are done. But investing is not assembling pieces. It is building a system. Without understanding correlations, the entire structure can collapse when one component fails. I once worked with a man who believed he was well diversified. He owned Apple, Microsoft, Nvidia, Amazon, Google, and Meta. I asked him, "Do you realize these all belong to the same sector?" He froze. In his mind, each was a separate company. In the market's mind, they were one bet. When big tech sold off, his entire portfolio sank like a boat with no second oar. Then there are fees. Here is a truth the financial industry rarely highlights. Many funds operate like product sellers, charging absurd fees. 1 or 2% per year sounds harmless. But over 30 years, those fees compound into massive losses. I once showed a client that switching from a high-fee fund to a low-cost index fund would save him over $750,000. He nearly dropped his coffee. Risk is another misunderstood word. Most people define risk as the probability of loss, but real risk is the gap between what you believe and what reality delivers. You think you can tolerate a 20% loss. Then you wake up one morning and see your portfolio down 25% in 2 weeks. Your stomach tightens. Sleep disappears. That gap between confidence and reality is true risk. There is also a subtler danger: overconfidence, especially among those who have succeeded before. They believe they are exceptions. They believe lessons are learned, doubts no longer necessary. The market does not care who you are. It punishes arrogance without hesitation. I remember a former CEO who turned a failing company into a media empire. Brilliant, disciplined, confident. He believed he could manage investments the same way he managed businesses. He made leveraged bets in a booming sector. Year 1, profits doubled. Year 2, total collapse. Year 3, he sold his house to pay debt. Intelligence is not armor. Sometimes it is the very thing that makes arrogance deadly. Another silent mistake is inaction. Not every failure comes from rushing. Some come from doing nothing, failing to rebalance, failing to cut losses, failing to adjust strategy when circumstances change. I once asked an investor why he kept a stock that had fallen 40% over 18 months. He said, "I don't know what to do." So he did nothing. Hope replaced discipline. Misplaced trust is the most dangerous behavior of all. Trusting a headline, a friend, a financial influencer, a famous personality. They carry no responsibility for your money, yet they shape your thinking. You cannot outsource judgment. If you truly want to invest wisely, you must start with your behavior. Write down your past mistakes. Name the emotions behind them. Be honest about decisions made for ego, pride, or fear. If you refuse to face yourself, the market will force you to painfully. One last silent destroyer: tax blindness. Many investors trade aggressively, executing dozens of transactions each month, never considering tax consequences. They celebrate profits without noticing the slow bleed: short-term tax rates, long-term taxes, fees stacked upon fees. Over time, they enrich the government more than themselves. I am not against taxes. I am against ignorance. And finally, humility. Not performative humility, but the real kind. The humility that emerges when you face failure and continue anyway. You stop trying to conquer markets. You learn to coexist with them. You do not aim to be the best. You aim to not destroy yourself. I once placed a note on my screen: do nothing today that your future self would be ashamed of. It saved me more times than any indicator. Bad behavior does not come from stupidity. It comes from emotion. Human emotion. Forgivable in life, unforgiving in markets. The greatest mistake is failing to learn from past mistakes. I met an investor who lost 70% during one downturn. 10 years later, he lost 60% in real estate. Then, in 2021, he poured money into crypto. I asked him, "Don't you see the pattern?" He smiled sadly and said, "I thought this time was different." That sentence, "this time is different," is the anthem of every financial crisis. poor behavior erodes more than wealth. It erodes trust in oneself. From there, people swing between extremes, from reckless trading to paralyzing fear. They stop thinking and start reacting, and that is when they stop being investors. They become prey. But recovery is possible. I have seen people rebuild, not markets, but themselves. One man lost everything. Then he spent 3 years reading financial history and keeping an investment journal. He wrote down emotions before every decision. He did not invest for 3 years. When he returned, he moved slowly. 10 years later, he was not a millionaire, but he had something rarer: calm. Investing is a mental discipline. No one wins by being fast. You win by not being defeated by yourself. You are not rewarded for buying the bottom. You are rewarded for not selling at the peak of fear. Survival is the ultimate goal. Behavior never appears on a portfolio statement, but it controls everything. The more you understand yourself, the less the market controls you. And that is the quiet advantage that lasts. Sound advice. I used to believe that successful investing required being smarter than others. But after many years, after living through financial shocks, through betrayals by so-called experts, and through mistakes of my own, I came to a different conclusion. Success does not come from becoming smarter. It comes from becoming less foolish. Most investment mistakes are not caused by lack of knowledge. They are caused by excessive confidence in what we believe we already know. If you are listening to this, there is a good chance you have lost money before. Not because you were incapable, but because you were not alert enough to avoid traps spread everywhere. Think of this part as a reconstruction of mindset. Not a shortcut to greatness, but a foundation. A foundation strong enough to recognize deception, and more importantly, strong enough to resist the madness of the market. We begin with the simplest principle: avoid mistakes. In my office, I hang a print titled "Fear and Greed." It reminds me daily that every financial failure is born from two ancient enemies: fear and greed. Not because I am special, but because I was once a victim of those emotions, and I paid for it with real money. Your task is not to become a financial genius. Your task is to avoid mistakes that are within your control. As Warren Buffett once said, you do not need to swim faster than the shark. You only need to swim faster than the injured swimmer next to you. Next, understand your advantage. You are not a hedge fund. You are not a macro analyst paid millions to predict the future. You are you, a person with limited time, specific goals, and a unique tolerance for risk. Your advantage is that you answer to no one, no quarterly pressure, no shareholders to impress, no obligation to act on rumors. If you understand yourself, you are already ahead of many professionals on Wall Street. And that is why you need a clear financial plan. A simple plan is better than 1,000 complicated promises. Write down why you invest, for how long, and how much risk you are willing to accept. Then, when markets soar or crash, you do not need to react. You return to the plan. You read it again, and you stay the course. If you lack confidence, seek help from someone with a legal duty to put your interests first. But choose carefully, not the best advertisement, the right person. Next comes indexing. Indexes, indexes, indexes. You do not need to pick stocks. You can own the market itself. Low-cost index funds, like broad market ETFs, offer a simple and powerful path to long-term success. They are not exciting. They are not flashy. But they outperform most stock pickers over time. Alongside stocks, remember bonds. Bonds are not for getting rich. They are for staying calm. Government bonds, high-quality corporate bonds, municipal bonds. They act as shock absorbers. When stocks panic, bonds provide shelter. And in every investment decision, pay attention to taxes. It is not enough to invest wisely. You must invest tax efficiently. Otherwise, your returns are quietly eroded. Strategies like direct indexing or thoughtful portfolio structuring can be powerful tools when used correctly. If you own a stock that has risen dramatically and you fear selling too soon, learn one principle. Minimize regret. Sell gradually. Rebalance. Keep part of the position. Do whatever allows you to manage risk without being tortured by the fear of missing out. As for alternative investments, hedge funds, private equity, crypto, or anything that sounds like a whispered promise of fortune, approach with skepticism. Unless you belong to the inner 10% with real access and understanding, step back. Remember this truth. Success does not come from being smarter. It comes from being less foolish. Most failures are not due to ignorance, but due to certainty. If you are here, you have likely learned that lesson the hard way. This section is not about speed. It is about durability, not about brilliance, but discipline. Avoiding mistakes is the core strategy. We live in an age where everything is personalized: music, diets, news feeds. Yet most investors copy others. They follow famous portfolios. Listen to distant podcasts. Let social media decide what to buy today. But investing is not a team sport. It is solitary. No one else can understand your risks or your dreams. Good advice begins with confronting yourself. What do I truly want? What keeps me awake at night? What am I willing to wait 10 years for? If you have never asked these questions, do not invest. You are throwing money into waves without knowing where you will land. Here's the paradox. Good advice is usually boring. It is simple, unexciting, emotionless, and that boredom is what keeps you alive. I have sat in million-dollar boardrooms listening to complex strategies, multi-asset leverage, global cycles, sophisticated hedging. 6 months later, those same investors quietly retreated to low-cost index funds. If advice sounds so obvious that you think everyone knows this, pause. You may be standing in front of a truth. Great investing is not about discovering new ideas. It is about executing old ones with consistency until others quit. Think of your future as a series of selves waiting ahead of you. Every decision today is a letter to that future self. What are you writing? Freedom or regret? Someone once told me, if I follow boring strategies, I will never get rich fast. I replied, that is true, but you will not get poor fast either. In investing, survival is the greatest victory. Learn to rebalance. Markets move, allocations drift. Rebalancing is not timing the market, it is steering the boat. Not because the boat is wrong, but because the current changes. Do not underestimate cash. Cash is not exciting, but it is oxygen during crises. You never realize how valuable liquidity is until everything collapses and opportunities appear when you have none. And finally, perhaps the most important advice, do not watch your portfolio every day. Live your life. Let money work. Doing nothing, when it is part of the plan, is often the best action. You do not need to do more. You need to do right and do it long enough. Doing right requires resisting instinct. When markets burn red, you cannot erase emotion, but you can place it inside a system of discipline, a system of rules, a system built on logic, not feeling. When markets go mad, do not go mad with them. Return to the plan. Read it again. This has happened before. It will happen again. I kept an investment journal for over 15 years, not just trades. Emotions, what I felt, what I feared, what excited me. Reading it later, I saw repetition. Markets change. Humans do not. That journal did not predict the future. It protected me from myself. If I had to give one piece of advice to the next generation, it would be this. Start early. Not because of saving, but because of time. Time turns small actions into large outcomes. Time is quiet, uncelebrated, invisible. But it is the most powerful ally long-term investors have. And if you care about results more than stimulation, you will choose time. Automate your investing. Remove emotion. Invest consistently. Regardless of headlines, you do not need brilliance. You need patience. After years of trying to control markets, I learned to control myself. True wealth is not how much you own. It is how many opportunities you can miss without regret. You do not need every trend. You need consistency. Set boundaries. Maintain reserves. Create zones of inaction when emotions rise. You do not need to be the best. You only need to avoid destroying your system. Knowing when to stop, when enough is rare wisdom. Sufficiency does not come from numbers. It comes from within. The calmest investors are often the quietest. They ask not which stock will win, but how to sleep peacefully. Design your life first, then design your portfolio. Any financial strategy that does not serve the life you want is meaningless. And above all, learn to look back, not with regret, but with understanding. You survived fear. You continued. That is strength. Do not predict markets. Measure yourself. Because in the end, the right advice is not about what to buy or sell, but about how to remain steady in a world that screams a long and quiet path. There was a time when I believed investing was about controlling the market. For 5 years, I tried to predict every move, every cycle, every correction. Then I spent another 5 years learning something harder: how to control myself. Only after more than a decade did I finally understand this. True wealth is not how much you own. It is how many opportunities you can miss without feeling regret. You do not need to invest in everything. You do not need to chase every trend. You do not need to win every cycle. You only need to do well enough, consistently, and survive periods of madness. Set guardrails for yourself. Keep an emergency fund, at least 6 months of living expenses. Create a zone of inaction for moments when markets shake violently, so you do not react while your mind is flooded with fear. You do not need to be exceptional. You need to avoid breaking your own system. This may sound ordinary, but in a world where everyone runs like moths toward the next big hit, doing nothing can be extraordinary. Learn to recognize enough. Know when to stop. Know when to say, "I do not need more." I once met a client with $18 million in assets who could not sleep. He kept thinking, "If only I had invested in crypto earlier. If only I bought more real estate last year. If only." I asked him, "When will it ever be enough?" He had no answer. Enough does not come from numbers. It comes from the mind. After decades of conversations with people holding hundreds of millions and others saving modestly month by month, I noticed something strange. Those who know clearly what they want are often the quietest. They do not ask which stock is hot, which fund is best, which trend is rising. They ask different questions. How can I live safely without constant worry? How can money stop being a source of fear? How can I avoid becoming a slave to numbers? I believe good investing begins with those questions. Design your life first, then design your portfolio. Where do you want to live? How do you want to spend your days? How much time do you want for family, books, walks, or things no one else values but you? Only after that should you calculate how much you need, how to invest, and what to avoid. Any financial strategy that does not serve the life you truly want is meaningless. And on this path, do not forget to reflect, not to regret, but to understand. You were wrong before, yet you continued. You were afraid, yet you did not quit. You doubted yourself, yet you kept doing what was right. That is strength. I once asked a seasoned investor if he had advice for younger generations. He sipped his tea, smiled, and said, "Do not try to predict the market. Measure your own mind." In a chaotic world where news changes hourly, where charts dance wildly, where noise is constant, the right advice is not about buying or selling. It is about how you remain steady amid the noise. You may not remember which stock returned 20% or which fund beat the market in 2016, but you will remember the days you did not follow the crowd. the nights you slept well, knowing you stayed true to your plan, the small decisions that made you proud to be a financially mature adult. Walk slowly, walk steadily, and do not walk alone. Find a healthy community, not to receive tips, but to be reminded that you are not alone in choosing calm in a screaming world. If there is one thing I hope remains after this book, it is this: investing is not a game of big hits. It is a long dance of small, correct steps, repeated with discipline and self-respect. Start with the simple things and continue. I do not expect these chapters to turn anyone into a genius. If you were searching for a magical formula or a chart that unlocks wealth, this book may disappoint you, but that is not its failure, and it is not yours. Because investing, at its deepest level, is not about formulas. It is about discovery, not of the market, but of yourself. Thank you for staying until the final page. Listening to ideas that may feel dry, uncomfortable, or challenging is proof that you take your financial future seriously. That is rare, and it matters. You may disagree with me. You may find me too skeptical, too harsh toward crowds, too conservative. That is fine. I do not need your agreement. I only hope you learn to doubt at the right moments. If this book offered you even one sentence, one example, or one unfamiliar idea that made you pause and reflect, then we have met. If you found value here, leave a note, not to praise, but to help others who are lost among endless loud advice find a quiet place to think. And now, I say goodbye until we meet again.